Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Virendra Kumar. The algorithmic amplification of fear. Why social media is making a modest market decline feel like a huge crisis. If one were to judge solely by social media commentary, you might believe we're in a devastating market crash. The reality, however, is far more mundane. The Indian stock markets have indeed declined over recent months, but by historical standards, this correction has been rather modest. The Sensex remains up 8.8% over the past year, and looking at the 5-year horizon, a more meaningful time frame for serious equity investors, the picture is even more reassuring despite including the dramatic COVID-19 downturn. We're witnessing less of a crisis and more of a natural settling of valuations that had grown somewhat stretched. As is typical during such phases, some companies have seen steeper declines than others. This isn't catastrophic. It's the market performing its natural function of separating the good, the bad, and the ugly. Yet, the outcry on social media platforms would have you believe we're facing a second global financial crisis. This disconnect between reality and perception reveals something crucial about modern financial discourse. The mechanics of social media actively encourage and amplify negative sentiment. The platform's algorithms are designed to promote engagement, and nothing generates engagement quite like outrage. Each pessimistic post feeds into a reinforcing cycle, creating an echo chamber of negativity. This phenomenon is particularly dangerous for investors because it can lead to poor decision-making. When your social media feed constantly screams that the sky is falling, it becomes remarkably difficult to maintain the emotional equilibrium necessary for sound investment decisions. The platform's preference for dramatic, attention-grabbing content naturally favors catastrophic predictions over measured analysis. What's particularly ironic about this situation is that historically, periods of widespread pessimism have often proved excellent times to invest. When everyone is shouting about market troubles, it frequently signals that valuations have become more reasonable. Yet the amplification of negative sentiment on social media makes it psychologically harder to take advantage of these opportunities. The current situation offers a valuable lesson in maintaining perspective for the fundamentally driven long-term equity investor. The market's performance over meaningful periods, the kind of horizons that matter for building wealth, remains positive. This reinforces a truth experienced investors understand. The daily noise of market commentary, especially on social media, is often inversely proportional to its importance for investment decisions. What should investors do in this environment? The answer is remarkably simple, though not necessarily easy to execute. Maintain your regular investment schedule, focus on fundamentals, and resist the urge to let social media sentiment drive your investment decisions. If anything, periods of heightened pessimism on social media might be worth noting as potential buying opportunities, provided your investment thesis remains sound and you're investing for the long term. The most successful investors I have observed over the years share one crucial trait. They treat market corrections not as disasters, but as natural features of the investment landscape. Just as the monsoon comes every year, markets will have their periods of decline. The key is to prepare for these periods not by trying to time them, an endeavor that has frustrated even the most sophisticated investors, but by building a portfolio that can weather them comfortably. This means maintaining adequate emergency funds, diversifying appropriately, and, most importantly, investing only those funds that won't be needed for several years. Remember, social media's primary function is to generate engagement, not to provide balanced investment advice. While platforms like X, formerly Twitter, and Instagram may be valuable for staying informed about company developments or broader economic trends, they should never be the primary driver of investment decisions. The next time you find yourself scrolling through a feed full of market doom and gloom, consider whether you're looking at genuine analysis or simply being caught in an algorithmic amplification of fear. Your investment decisions and your returns will be better for maintaining this perspective.